Good evening. We begin tonight with a significant development in the global commodities market. Silver has crossed the $100 per ounce threshold in early 2026, marking a psychological and financial milestone for a metal that traded predominantly between $15 and $30 throughout much of the previous decade. This achievement follows a 40% gain in the opening weeks of this year, building upon a remarkable 147% surge recorded throughout 2025. The rally has captured attention across investment communities, prompted questions about sustainability, and forced a fundamental reassessment of how investors evaluate companies operating within the silver mining sector. The drivers behind this extraordinary price movement have been multiple and interconnected. Retail demand accelerated significantly beginning in October 2025, with individual investors purchasing small bars and coins in substantial volumes. Physically backed silver exchange-traded funds experienced sustained inflows during this period. These demand surges occurred simultaneously with prolonged tightness in the London silver market, where available stocks in commercial vaults reached a record low of 136 million ounces by the end of September 2025. For context, this figure represents a dramatic decline from approximately 360 million ounces that were available during the retail-driven rally in early 2021. However, market analysts are now pointing to emerging signs that suggest this rally may face headwinds. The gold-silver ratio has compressed to 50-1, down from 105-1 recorded in April. This ratio, which indicates how many ounces of silver are required to purchase 1 ounce of gold, is used by traders and analysts as a gauge for future price direction. The current level represents the lowest reading in 14 years and signals that silver's outperformance relative to gold may have extended beyond levels supported by underlying fundamentals. Financial institutions are beginning to express caution about current price levels. Bank of America has released estimates suggesting that fundamentally justified silver prices are closer to $60 per ounce. The investment bank's strategists indicate that current levels above $100 reflect momentum and positioning dynamics rather than industrial demand fundamentals. They note that consumption from solar panel producers likely peaked in 2025 and that industrial buyers are facing pressure from record high prices. Liquidity conditions in the physical market are showing signs of normalization. London stocks, which had fallen to critical lows, have recovered to nearly 200 million ounces by the end of 2025. This recovery helped drive down lease rates from their October spike, though inventory levels remain well below historical norms. On the COMEX exchange, inventories peaked at 532 million ounces on October 3rd before declining by 114 million ounces to 418 million ounces by year-end. This represents the lowest level since March. Analysts anticipate that outflows from United States stocks will accelerate following clarity on tariff policy that emerged in mid-January. This development is expected to further ease the physical tightness that provided support for prices during the rally. Technical analysts have flagged the rapid nature of silver's gains as positioning the metal for a potentially major correction. Strategists at BNP Paribas have noted that profit-taking following what they describe as the frenzied nature of the investor-driven rally since late November is likely to occur sooner rather than later, particularly given the ongoing easing in physical market conditions. For investors holding positions in silver mining equities, this environment requires a fundamental recalibration of strategy. Throughout 2025, momentum and price exposure delivered substantial gains as the metal surged higher. However, correction risk is now rising as physical market conditions ease and positioning becomes stretched. The market is beginning to differentiate between companies that can convert elevated prices into durable cash flow and those whose valuations depend primarily on sustained momentum. This shift in market dynamics carries significant implications. In late-cycle environments, leadership typically moves away from high beta optionality plays toward companies demonstrating execution capability, funded balance sheets, and credible operational milestones. The question confronting investors is no longer whether silver can rally further. Instead, the focus has shifted to identifying which companies can deliver results if prices remain elevated, and equally important, which companies possess the financial and operational resilience to survive if a correction in the range of 25 to 35% materializes. The structural backdrop for silver remains intact, despite these concerns about near-term positioning. The silver market has experienced 5 consecutive years of structural deficits, meaning demand has exceeded newly mined supply and recycling volumes. These deficits have been compounded by limited high-grade refining capacity, which has constrained the speed at which recycled material can return to available supply. These fundamental dynamics continue to provide underlying support for prices over the medium to long term. However, the disconnect between current prices and fundamental estimates from major financial institutions suggests that momentum and positioning have become significant components of the current price level. Investment demand remains robust, and deficits are expected to persist through 2026. Yet the physical market is no longer experiencing the acute tightness that characterized conditions in late 2025. This normalization reduces one of the key pillars that supported the rapid price advance. The compression of the gold-silver ratio to 50-1 represents a particularly important signal for market participants. When ratios compress this sharply over a short period, the risk of mean reversion increases substantially. Historical patterns suggest that extreme movements in this ratio are often followed by periods of adjustment as the relationship between the two metals returns toward longer-term averages. While this does not invalidate the structural case for higher silver prices over time, it does suggest that the pace of gains may moderate or reverse in the near term. Mining executives are acknowledging the dramatic change in the operating environment. Diane Garrett, Chief Executive Officer of Hycroft Mining, stated that the company cannot ignore what has happened to commodity prices, describing the movement as spectacular. She noted that this price environment, combined with a cleaner balance sheet, new institutional shareholders, and positive drilling results, positioned the company to begin the year with a market capitalization exceeding $2 billion. This represents a remarkable transformation for a company that faced significant financial challenges in prior years. The new price environment is forcing mining companies to accelerate decision-making processes and advance projects that may have remained on hold at lower price levels. Companies with permitted projects, funded balance sheets, and near-term construction timelines are positioned to capitalize on current conditions without depending on sustained momentum or favorable financing windows. Conversely, companies that require additional capital raises or face extended permitting timelines carry greater risk if market conditions tighten or if silver prices correct before key milestones are achieved. The market is also beginning to reward operational discipline among existing producers. Companies demonstrating stable operations, credible cost control, and improving margins are attracting investor attention as participants seek downside protection alongside upside exposure. At price levels above $100 per ounce, even modest production volumes generate substantial cash flow for companies with well-controlled cost structures. This cash flow generation provides funding for expansion, reduces reliance on external financing, and offers a buffer against potential price volatility. As we examine this developing story in greater detail, we will explore how specific companies within the silver mining sector are positioning themselves to navigate this environment. We will analyze the characteristics that differentiate companies likely to outperform, regardless of whether prices continue higher or experience a correction. We will review the specific milestones and catalysts that investors should monitor throughout 2026. And we will provide a framework for evaluating which companies possess the execution capability, financial resources, and operational visibility to deliver results in this late cycle environment. The transition from speculation to execution in the silver market represents more than a shift in investor sentiment. It reflects a maturing of the current cycle and a recognition that sustained value creation requires more than exposure to rising prices. As physical market conditions normalize and positioning becomes stretched, the companies that demonstrate delivery capability and maintain financial resilience will be positioned to lead the next phase of this market, regardless of near-term price direction. We will continue our coverage with a detailed examination of what changed to drive silver above $100, why correction risk is rising, and which specific factors investors should monitor as this story develops throughout the year.